Okay, for some revision, we're going to look at some depreciation. So this is key because it always comes up on the income statement and the statement of financial position. So it's really important to be able to do both types of depreciation, as is in that last point, the straight line method and the reducing balance method, and to know what numbers we've got on income statement of financial position. So first of all, I want you to think back to see if you can actually remember what depreciation means. If you're asked to define it, what would it mean? So it's reduction of the value of a non-current asset over time. And the reason we do this is because if we have a non-current asset like a vehicle for 5 years, it's obviously going to be worth less than it was when we bought it. But if you treat it as the same amount, the same initial value, then you're going to be overstating your assets. It's going to look like you've got more assets than you actually have, which is against prudence. So it's the value of non-current assets decrease over time. So we include it so we don't overstate the value of assets, like we've said. And depreciation, the key thing is it affects the profit for the year, but it doesn't actually affect cash. So normally it goes out the bank for depreciation. It's just an expense that reduces your profit. So from the soft, remember to work out the net book value, you start with the cost, you take with the accumulated depreciation or the provision for depreciation or total depreciation, whatever you want to call it, and you get the net book value. So that's how much it's worth. So there's two ways to calculate it. There's the straight line method, which is the easiest, and this is similar to the simple interest that you saw at GCSE. And to get the depreciation for the year, you just do the percent of the cost value. So here's an example. We buy a machine for 18,000 and we depreciate it using the straight line method at 20%. So you do 20% of 18,000, which is 3,600, and that would be how much it depreciates each year. So if you fill in the table, which is on your worksheet, you just get these answers. So in the first year, there's no depreciation. So the net book value is 18,000. After 1 year, the depreciation for that year is 3,600. So the cumulative depreciation is 3,600. So we take that away to get a net book value, 14,400. After 2 years, that second year's depreciation is still the same, but the total depreciation now was 2 lots of them, so 7,200. So we take that away from 18,000 and we get 10,800. And same with the third year. It's another 3,600 and we take it away. So nice and straightforward. The second version though, this is when they don't give you percent, but instead they give you how much they expect it to be after so many years. So you can use a formula for this, and this formula just works out the difference between how much you paid for it and how much you expect it to be, and divide by how many years. So that tells you how much you should take away each year. So it's a very straightforward formula. It's an obvious formula. So it's the cost, take the estimated disposal proceeds, so how much is it would be worth after so many years, divided by the estimated life expectancy, so how many years you're going to keep it. So we buy a machine for 18,000 and expect to use it for 5 years with an estimated value of £12,000. So that means it's going to decrease by £6,000 over 5 years. To divide by 5 means it's going to decrease by 1,200 each year. So the depreciation each year still stays the same. It's still 1,200, and the cumulative depreciation still keeps building up, and the net book value still keeps decreasing. Yeah, so this one's more straightforward one. Straight line method, straightforward method. It's the same each year. So have a go at filling in that table. So press pause, get your workbook out and fill it in. And then check your answers. The second method is the reducing balance method. Now this is the one that was similar to the compound interest at GCSE. And to get the depreciation for the year, you do a percent of the net book value. And we know the net book value changes each year, so therefore the depreciation will change each year. It's not going to be the same each year. So the same setup, the machine's 18,000, and we depreciate it at 20% using the reducing balance method. So the first year, there's no depreciation. Sorry, when we first get it, so we've had it no years, there's no depreciation, so net book value is 18,000, it's cost. After 1 year, we do 20% of 18,000. To get a net book value, it's 14,400. But for the second year, we would do 20% of 14,400 to get that depreciation. Then we would add that depreciation on to the current total. So we do the 3,600 add 2,880, and then we take that away from the cost to get the net book value. Then for the third year, we do 20% of current net book value, so the 11,520. We would add that depreciation on to the current provision for depreciation, the current total, to get 8,784, and take that away from the cost to get 9,216 as the net book value after 3 years. So these numbers tend to get nasty and you get decimals, and it's not as nice as the straight line method. So again, can you have a go at filling in that table? So work out the net book value after each year. And this is the one where, for example, this is one where you could use the powers. So if the depreciation is 10%, for 1 year, you could do 20,000 times 0.9 to the power 1. For net book value after 2 years, you could do 20,000 times 0.9 to the power 2. That gets you the net book value. It doesn't tell you depreciation, just the net book value. And you should get those numbers. And then we have to think about how does it look on the financial statements and how is the double entry bookkeeping. So the financial statements, on the income statement, we list this year's depreciation as an expense. So only the depreciation for the year goes on the income statement. So the smaller of the two numbers. The provision for depreciation, the total depreciation, that goes on the soft, and we take it away from the cost to get the net book value. So remember those three numbers we have right at the top of the soft. And for the bookkeeping, depreciation reduces the value of an asset, so therefore it's a credit entry. So we credit the provision account and we would debit the income statement. So that means the other number appears in the income statement. Remember, the income statement is part of the double entry bookkeeping. It's just not really set out like a T account. So let's look at this example here. So a machine is purchased for £2,000 by bank transfer on the 1st January 2011. It is decided to depreciate at 20% each year using a straight line method. The firm's financial year runs from 1st January to 31st December. The account records for the first 3 years will be, so we have to have a go at filling them in. Now my animation skills aren't very good here, so you just want to see all the answers all at once. But if you think about it, so when you purchase something for £2,000, the machine account will increase. So it'll be a debit, that's an asset. So on the debit side, you would put bank £2,000 on the 1st of Jan. Then at the end of that year, you depreciate it by 20%. So 20% would be 400. So you put £400 on the credit side of the provision for depreciation. And then what you do is you would transfer that with, you would balance that, and then you would start off the next year. So if I just show you then, so we can talk through it. So the machine account, like I said, bank 2,000. Then on the provision account, so the end of the first year, so the 31st December 2011, we put £400 on the credit side, and we call it income statement because we're transferring that to the income statement. We then balance that, so £400 on the debit side. Then we bring it down as a BD on the 1st of Jan 2012. Then again, at the end of that year, we would put a depreciation, and since the straight line method, it's another 400. Then we would balance that, so that's how we get 800, balance CD on the other side, bring it down to get 800 for the balance BD. And then again, the depreciation at the end of that year, so the 31st December 2013, another 400, balance that to get 1,200, and then bring it down to BD on the credit side, and it's going to keep going like that. So it'll keep increasing until you either sell it or you buy more machinery. And that's what the income statement and soft will look like. So each year the depreciation will be the same because it's a straight line method. But on the soft look, that second column is the depreciation. So the first year there's only 400. The second year the total is now 800. And the third year the total is now 1,200 for depreciation. Okay, have a go at answering the questions from the sheet and let me know if there's any issues, because we need to master this ready for year 13. In fact, we really should master this before all the financial statements, but I know some of us struggle with this. So try your best, and again, let me know any issues.